Thanks, Eric. And firstly, let me add my congratulations and thanks to Kyle and Jeff for their vision in founding, championing, and all the spirit that came into Capitalize for Kids that not only creates the best investment conference in this country for sure, but has done wonderful things for kids' mental health. So thank you for that. Very briefly on vision. Vision is focused on one thing: publicly traded real estate securities. We operate long and short. We seek to be active investors. We've had 16 takeovers in our portfolio holdings, including GGP, in the last 11 years. 3 senior guys at the front end of the portfolio team. Frank Mayer. Frank was a top-ranked real estate research analyst for 35 years. Andrew Moffs, who in 20 years with APG, the Dutch pension fund, and a co-founder of Starwood Real Estate Securities in Greenwich, Connecticut, doing one thing: real estate securities, long, short. And myself, who has 10 years of corporate real estate experience with Olympia, New York, Bramall Lee, and 15 years of real estate banking with HSBC and Desjardins. And 12 years ago, Frank and I founded Vision. Our mantra is we buy real estate cheaper in the stock market than one can in the property market. And if you're a shopping mall in suburban Pennsylvania, you lose your Sears, you can turn out the lights before you leave the parking lot. You can't do anything about that. Or if you're an office building owner in Calgary, Alberta, Canada, it's going to be, in our view, 10 years before you recover your capital. You can't do anything about that. We can do something about it. We can be short. We launched July 08. We're up about 330% net of all fees and expenses, about 13.5%. But the most important thing, in my view, about Vision are not our returns, which are compelling. It's our risk profile. We don't seek to be the best performing fund in North America. We would like to be the best risk-adjusted performing, and this is fun, and this is where we stand out. We've never had a down year in a context where 2013, 15, and 18 were down years, either in the broad markets or the REIT markets. We were positive, and we've had a flat to negative down market capture ratio, which means on average over the last 11 years, when markets have been down, our fund has been up. We have a very boring business to talk to you about today. And at Vision, we get really excited about boring investments. This investment is in U.S. rental apartments. This is the most defensive real estate sector out there. Everyone needs to live somewhere. Financing. There was a lot of concern expressed about financing here over the last 2 days. Well, you can always get mortgage financing for apartments because Fannie Mae and Freddie Mac in the US, up here in Canada, CMHC, not only do they offer cheap debt, say 70 basis points over bonds, but unlike commercial real estate, because of the government guarantee, you can always get it, even in the depths of the credit crisis. And in particular, we're talking about affordable apartments, or Americans don't like that, they like workforce housing, because affordable apartments provide both offense and defense. On offense, our blood is supply and demand. If you get supply and demand right, because you don't have 5 and 10-year leases, you can get above average rent growth. And defensive, because they're recession resistant due to the price point of low rents. And this has been the best performing real estate sector in the REIT sector over the last 20 years. Millennials are the story, or at least part of the story. There are 66 million Americans between the ages of 20 to 34 years of age, and they rent apartments, and there's an increasing lifestyle propensity to do so. And right following behind them is Generation Z, or Z, if you will, which is forecast to be the most populous generation of all time. You look at the other age of the spectrum, the leading edge of the baby boomers turned 75 in 2021, and so that cohort is moving from home ownership to rental apartments. So you have 50% of the US population which is renting apartments and have an increasing propensity to do so. Household formations. Recently, household formations have gone up, but all of the household formations in the United States are going to rental housing, not ownership. Ownership has been flat to declining. First quarter this year, U.S. Census Bureau reported 500,000 new renter households year over year, and stricter mortgage criteria on both sides of the border are contributing to a decline in home ownership. You know, my parents got married at 20, 21 years of age. Young adults today, they get married 28, 30, 32. My parents had 4 children by the time they were 25. Young adults today have babies, 28, 30, 32. Mom, I'm 38. You think I still have a baby? Both of these, delayed family formation, is increasing demand for rental accommodations. Never mind the lifestyle choices of wanting to walk to work and go to restaurants, etc. Singles. Over 50% of the US population is single. That surpassed 50% in 2014 and is growing. They live in apartments. Young professionals staying at home longer. Part of this is created by the 2008 recession and loading up of student debt. The amount of student debt that out there is incredible, and that was a down payment that folks thought they had was destroyed in 2008 for buying a home. And so there's pent-up demand. Over 2.3 million young adults that are living at home that typically would be out in home ownership or renting apartments. Pre-recession, it was 27% of 18 to 34-year-olds were living at home. Today, it's 31%. Income levels. 75% of households are living paycheck to paycheck. Middle-income families spend much less. They save a lot more, 10%, in fact, by renting than owning. And there's a lot of saying, well, rents have gone up a lot. It's not really affordable. Yeah, rents have gone up over the last 50 years. They've gone up 69%. But incomes have gone up 89%. So it's actually cheaper today to rent than it was 50 years ago. So our investment thesis today for you is BSR REIT. BSR REIT is one of those unique entities which is 100% US properties, but is listed exclusively in Canada. And there's been a few of these. They've been great investments. They're off the radar screen for Americans, and they're compelling. This particular REIT has 47 properties, just over 10,000 apartment suites, and note, the average monthly rent is $858 a month. Over 50% of the current, focus on current, net operating income is earned from the state of Texas. Very powerful story here is management. All of these REITs that came public in Canada initially had external management teams with various types of contract, so a lot of misalignment, a lot of fees. This is internally managed. In fact, the CEO takes no salary. Moreover, John Bailey, the CEO, his family, and another large family that's not part of management, own 50% of the units. You want to talk about alignment, 50%. They did not only not sell at the IPO, which was March 2018, they bought stock at the IPO price. Our blood is supply and demand. It's not location, location, location. This is a myth. It's not interest rates. It's supply and demand, like every other speaker here today. Supply and demand drives it. And if you look at supply and demand, that is compelling in this story. The supply side is relatively easy. How many buildings are out there? How many are being built? How occupied? Demand is tough. The factors driving demand, firstly, population growth. In the Southwest United States, the multiple of population growth to new supply is almost 30 to 1, whereas the national average is 20 times. And so this is compelling. And in fact, when you look at jobs, because jobs is the key to demand side, whereas the national average is 8.5, in the Southwest, it's 12.6. So this is compelling. Supply and demand is very much in balance. Moreover, at $850 a month rent, you're largely immune for new supply. Nobody can build a new apartment building and for $850 a month rent. It just doesn't happen. It can't happen because nobody, even in the world of negative yields, is going to build apartment buildings for rents that are well below replacement costs. Where is the population going? Austin, Texas, Dallas-Fort Worth, Houston, Texas. Those are BSR's amongst their core markets. Those are 3 of the top population employment growth markets in the United States, and we don't see in that changing whatsoever. People are migrating from California to Texas because of taxation. These guys don't buy buildings and hope things are going to go well. They're value add. This is a hands-on, deeply experienced management team and management platform. For example, we toured the property down in Dallas they recently bought. The rent's $1,100. They spent $10,000 per unit to fix up these these units, new countertops, new appliances, new fixtures in the bathroom. $10,000, they move the rent from $1,100 to $1,250. First year return, 18%. Annualized, $1,800. That is $24,000 per suite value creation for a $10,000 investment. That's what we like, value add aligned management teams. And this management team is not going to issue capital dilutively just for the sake of growth. And what they were doing, because it was an early stage, their stock was undervalued, is the recycling capital and doing the exceptional job doing that. And they're taking advantage of the Blackstones raising $20 billion in new funds and chasing this asset class where the spreads between Class A and Class B cap rates and between primary and secondary markets have gone to historical lows, and they've been recycling capital. And the result of this is going to be they're going to eventually be heavily focused on 5 markets: Austin, Dallas, Houston, Little Rock, Oklahoma City. They've sold buildings. They have announced other properties under contract. And the result of this is you can estimate that the pro forma net operating income, when this exercise is complete, will be 70% from the state of Texas. Compelling valuation. There's a lot of U.S. apartments REITs. If you just look at those that are most comparable to BSR REIT, they are trading at a 19% premium to the underlying net asset value of the real estate, which is something, I don't know about 19%, but you'd expect. They're more than a collection of assets. These are management teams that add value over time. A 21, 22 times cash flow multiple. BSR is trading at 11% discount to the current value, recognize current value, as estimated, or a 14.6 times multiple. The other way to talk about it in real estate speak is the average cap rate implied by the U.S. comps is 4.9%, where BSR REIT today is 6.4% cap rate. Where do you buy U.S. apartments, the most highly sought after asset class in the real estate world, in high growth markets, at an 11% current discount, we believe much more significant discount? The answer is the Toronto Stock Exchange. And we've seen this movie before. I mentioned this as one of a handful. We've seen it, Milestone REIT, all U.S. apartments, Class B apartments in the Sun Belt, Pure Multifamily REIT, all U.S. apartments, also listed exclusively in Canada. Both of these had very successful year-over-year investments for folks, and ultimately both of them taken out at premiums to their net asset value. Milestone, a 9% premium in 2017, and in this last month in September, Pure Multifamily REIT, and I believe Vision was the largest shareholder of Pure at that time as well, an 11% premium to its net asset value. This is apartments. It's real estate. It's relatively easy to value. Do your work. You'll see what we're talking about. And that's what, this is not technology. This is not healthcare. The difference in real estate is the private market dwarfs the public market. So there's an arbitrage between the private and private markets that I don't believe is relevant, at least to the same degree, in any other asset class, where you can identify, arbitrage, and surface that value. And unlike Pure and Milestone, which were both initially externally managed, as I mentioned, BSR is starting off right in being internally managed. Why is it undervalued? Why? Firstly, it was a poorly executed IPO. It's an early stage story. It's a prove me story. It's off the radar screen from the Americans because it's listed up here in Canada, and it's relatively unknown in Canada. Some folks said, well, what about these secondary market assets? That's changing, but they're good assets. There's limited research coverage. That is changing. There's limited institutional ownership. That changed about a month ago as well. And so the catalyst to surface this value, certainly broader institutional ownership. We've seen this time and time again in the Canadian real estate space. You're going to see increasing asset size, increasing market cap, growing cash flow. This net asset value is going to change on its own. There's going to be more research coverage, more liquidity coming in this name. And because of this recycling, you're going to see a re-rating of this stock. Never mind all the other factors, you're going to see cap rates coming down as they focus on these core markets. Folks are now inked their property tours. You're going to recognize the management competence, and we see long-term growth, year-over-year growth, and ultimately this management team is aligned to service value for all investors in a similar way. So where is it worth today? Easily. Never mind 4.9% with U.S. comps trade at, just get 6 cap. 6 cap, you're looking at a stock just under $12.80 or $12.80. And you add in a very compelling yield, a 4.4% yield with a lower payout ratio than the Americans, you get about a 17% total return over the next year. You look at re-rating the stock, which we believe will occur, you can get up to a 56% return if this trades down just above where the US comps are. So just to wrap up, why BSR? We see it the right asset class, apartments. Again, it ain't location, location, location. It's not interest rates, it's supply and demand. Best markets, high growth, supply and demand is in balance. The management team, highly aligned, highly competent management team. They have a disciplined, differentiated, and very focused strategy and a very compelling evaluation. Now I got 2 more minutes, so Eric gave me a little plug. We struggled here for 2 names that we wanted to talk about, so I want to satisfy Eric's thirst and tell you the next takeover candidate that we see is Liberty Property Trust. I'm going to give you 1 minute on Liberty. Liberty is $8 billion market cap, New York Stock Exchange in industrial real estate. Again, where do you buy industrial real estate at a discount? In this case, a 13 to 20% discount. In our view, easily today, probably 20 to 25% on the New York Stock Exchange. Liberty Property Trust, if you're looking for the next takeover. Blackstone just bought Colony a few months ago. If you use the cap rate that they bought Colony at, you get a 33% total return. If you use the public comps, 36%. So if you want to address Eric's question, Liberty Property, I'm going to get you out of here early for lunch. Thank you very much.